So then from the returns perspective, you're saying what should be more important rather than a point to point, or should we look at something called rolling returns? And if you can, talk about it a bit.
So you're right. So returns, you can't ignore returns. I mean, come on, we're in it to make returns, right? So Absolutely. You can't say invest in XYZ equity fund though it's given a poor return. We can't say that. The only thing is you've got to understand what returns actually mean. You have to put it in perspective. So when you talk about rolling returns, certainly a far better framework for evaluation. So what is rolling returns? So for example, if a fund has been around for 10 years, there are many 5-year periods in that 10-year phase, right? Multiple 5-year periods from Jan to Jan 5 years and Feb to Feb, so on and so forth. And so when you talk about rolling returns, it's basically a cumulative average of all these rolling periods, right? And I think that's definitely, if you have to consider returns, point-to-point returns are meaningless because, okay, let me ask you, is a 70% return good?
I mean, it's very subjective.
Extremely subjective, right? Absolutely. Now, is a minus 10% return bad?
Yeah.
Again, very subjective. What if the market has fallen by 30%? Correct. And my fund has fallen by just minus 10? Then it's a drastic outperformer. So point-to-point returns are meaningless. Actually, Sumana, even rolling returns are meaningless. I'll tell you why. Unless you compare them with something.
Okay.
Right. We will, of course, talk about risk later on, I think, in our discussion. But every fund has a different risk framework, right? So there are funds that invest into pure large caps. Those, I would say, are the least risky out of equities. Equities in themselves are a high risk category. But within equities, you've got small caps, you've got thematic, you've got sectoral, you've got all these different categories. So unless I compare the rolling returns from a large cap fund with, say, the rolling returns from the Nifty or the S&P BSE 500, I've just got a number. That number means nothing. In the end, I am paying a price for investing in a mutual fund, right? I'm paying fund management fees, I'm paying an expense ratio. So to get bang for my buck, I must get outperformance, right? So I have to compare the rolling returns from these funds with the rolling returns from the index, right? So that suddenly gives me a better perspective. So worst is that sort by 1 or 2 year return. Second, I'd say a step higher is rolling returns. And the best framework for evaluating any fund based on returns is maybe a 5 to 7 year period, first of all, for equities. So that automatically eliminates a lot of new funds, right? Take rolling returns over 5 to 7 year periods and compare them with the benchmark. And I would say a fund that has outperformed the benchmark on a rolling return basis for about 7 out of 10 times is definitely, on a returns basis, can be labeled a fairly decent performer.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.